So we can
Have you
start.
seen it?
Let's start. Let's start, sir.
Okay, we have seen it. You have seen the
No, we
slide?
haven't. Maybe it's still downloading. No, sir.
Maybe
Maybe
it's
it's
still down.
downloading.
Yeah,
Let's
maybe it's
start.
still
No, sir, we can see your screen. You are sharing the screen, but it's not
You have seen the
the
screen.
slide is not on
Okay.
Okay,
the
we can see
platform.
your screen.
We are
Okay,
just seeing
okay.
your screen.
Okay.
Let's follow your
So
screen.
okay. So this afternoon we are looking at governance, because I want to be having a sort of balanced lecture now: strategic management, risk management, governance. Before I have it in mind that the strategic management aspect of the syllabus are too voluminous. After strategic management, we move to governance and risks. But the way we are mixing it, I really love it to give us a very comprehensive understanding of what the task ahead is, and the fact that it's not only strategic management that we are looking at. So we are starting with governance this afternoon. So to start with, we are looking at the meaning of governance, just a brief or concise meaning of governance. So the God will give us the spirit of knowledge, retentive memory. So what is governance? So corporate governance is defined in the Cadre Report of 1992 as the system by which companies are directed and controlled. That's a very simple and acceptable definition of corporate governance universally across the globe. And at times, instances occur whereby we have some exams even in ICAN that the examiner can say, give a concise definition of corporate governance or acceptable definition of corporate governance. Or they might say, in line with the Cadre Report of 1992, attempt the definition of corporate governance. So the Cadre Report of 1992 defined corporate governance as a system by which companies are directed and controlled. So meaning that what corporate governance is all about is how the corporate entity, companies, are being directed, managed, controlled to ensure compliance, transparency, and achievement of the owner goals and expectations. Because corporate entity, organization, the more the company has been registered, fully registered, it has begun its own artificial life that is quite different from that of the owner of the company. So the owner of the company are compelled by the constitution of the company to appoint directors. These directors are vested with authority and responsibility to manage and govern the company in the best interest of the owner and achieve the pre-stated goals and objectives. So before leaving that again, corporate governance is the system by which companies are directed and controlled. To shed more light on that, and for us to erase any element of doubt, corporate governance should not be confused with management. That means there are distinctions or disparity between corporate governance and management, because management is concerned with running the business operation of a company. So the focus of management and the essence of management is to run the business operation of the company. But whereas governance is about giving a lead, monitoring, and controlling management decisions. So that means the management is all about running a business operation of the company, but governance supersedes the running of a business operation, in that governance is all about creating a leadership position, creating a pathway for achievement of the goals, monitoring and evaluation of operational business activities, and controlling management decisions. Secondly, management is about making business decisions. What we call management, it is about making business decisions. While on the other hand, governance is about monitoring and controlling decisions, as well as giving leadership and direction. So if management is about making decisions, the essence of governance is to ensure that these decisions are made with the utmost interest of the owner. The decisions are made with transparency, equity, with disclosure, and to ensure that decisions are meant for the benefit of the company and achievement of goals. Because you are not expected as a director to make any decision that will conflict with the vision and mission statement of the company, or to make a personal decision to enrich your pocket or perpetrate any fraud. So whatever decision that we are making should be with utmost good faith. And that's the more reason why governance monitor every decision make, they control decision make, and as well provide a leadership and sense of direction. So we've talked about this, that if management is about running a business, then governance is about seeing that it is run properly. So this is one of the disparity between corporate governance and management. So therefore, before proceeding, we can conclude that corporate governance is not about management activities and managerial skills or techniques. Rather, corporate governance is about the power of the executive management to direct a business. That is what corporate governance is all about. And that's the more reason why the executive directors, ED, the board of directors, they're always held accountable for whatever decision they make. Summarily, you can have is that corporate governance is concerned with matters such as, those are the areas of concern. Even in the syllabus, I can stress this, that the students are required to know the areas of focus of corporate governance. So corporate governance is concerned with matters such as in whose interest is a company governed? And a company should be governed in the interest of the owners. Because the board of directors can be regarded as agents under corporate governance, while the owners are the principal. So in whose interest is a company governed? 2, who has the power to make decisions for a company? Number 3, for what aims or purpose are those powers used? The decision of the company, the power to make decision is vested on the board of directors. And for what aim or purpose are those powers used? It is aimed for effective governance, meeting and satisfying the expectation of the owners of the company, achieving going concerns, sustainable growth, compliance. These are some of the purposes for which those powers and the decisions are made. Apart from that, in what manner are those powers used? The power should be used with transparency, equity, personal judgment, utmost good faith, and not to benefit the personal interest of any of the directors. Also, another question that we have is that, are the governors of a company held accountable for the way in which they use this power? Yes. All the board of directors, the CEOs, and the rest, they are held accountable for whatever manner in which they have used the power vested on them. So having looked at that, we quickly look at separation of ownership from control. But we have different subtopics to look at under this particular topic this afternoon. Separation of ownership from control. In the separation of ownership from control, we start by knowing that problems arise with corporate governance because of the separation of ownership of a company from control of the company. Because normally, once the directors have been appointed, they have that fiduciary power, the legal and statutory power to govern and manage the company. As a result of that, some of them might not use this power in the best interest of the shareholders. And majority of the shareholders too, they might not have that power to remove immediately dictate or influence the decision of the directors, unless they use their voting power when they have the majority shareholders to vote and remove the directors. So anytime there is a separation of ownership and control, it means the owners of the company, the owners of the company are the shareholders, while those people that is controlling it, they are the appointed board of directors. So that we have in second paragraph, that a company is a legal person. So in law, a company exists independently of its shareholders who owns it. Because I've told you that the company after registration will become an artificial being. So if you want to sue, you sue in the name of the company and not that of the owners. And according to the constitution, company constitution, the company law, the constitution of a company usually delegates the power to manage a company to its board of its director. So once we delegate the power to them, we have separate ownership from control. Because we have given that power to manage, to control the company to the board of directors. So what are the likely problems that normally arise from the separation of ownership and control? I mentioned about 2 or 3 in the course of explaining. So let's look at it again. Problem arising from the separation of ownership and control. The separation of ownership and control creates problem for good corporate governance. Because why are these problems created? Look at number 1. The directors of a company might be able to run the company in a way that is not in the best interest of the shareholders. Possibly when they are looking for job here and there, before they are being appointed, all of them will lobby here and there. And by the time that power is given, they become the directors. Majority of them derail. Majority of them, they become so powerful, they don't have listening ear. It's like drumming to a deaf ear. Until when they push the shareholders to the point of no return, that they have to exercise the power of vote to remove them, or they can remove them through what we call shareholders activism or retirement by rotation. So what normally causes problem is that majority of the directors, they might run the company not in the best interest of the shareholder. That one brings what we call problem in separation of ownership. And that is one of the major problem of agency relationship. Another thing that creates a problem is this. But the shareholders might not be able to prevent the directors from doing this, from perpetrating their personal interests, because the director have most of the power to control what the company does. It has become so difficult in lacuna tax to remove them, unless during the AGM or EGM, extraordinary general meeting, that this matter is being debate and is subject to voting to remove all the affected directors. But this problem can be minimized if we have these number 3 points. What is number 3? When the shareholders of the company are also its directors, problems with corporate governance are much less likely to arise. Yes, when we have some of the shareholders being part of the board of the directors, this minimizes the agency problem and corporate governance problem. So there will be check and balances, knowing fully that some of the owners of the companies are on board. Also, number 4, when a company is controlled by majority shareholders, this minimizes drastically the problem of governance, because the majority shareholders have the power to remove any directors that go contrary to the vision and mission statement of the company, any directors that run the company for its own personal gains, or any director that does not embrace the principle of disclosure, transparency. But some of the problems that we have in removing the director is that when we have directors on the board of directors, and the shareholder that we have on the board, they are not majority shareholders. the directors can still maneuver them, play along with other directors to ensure that they finish their tenure, or it will be difficult for them to be removed. Because when we have problems with corporate governance, generally arise when a company has many different shareholders and there is no majority shareholders among them. So with this one, it will be difficult for them to exercise shareholders' activism or speak with one voice. And another thing that we have is that some of these shareholders at times, they don't have a very stable tenure. Majority of them sell their shares at the short time. They sell their shares, they have to go and buy another shares elsewhere. So this one will not give them opportunity to stay very long in a company and have a full material knowledge of activities of what is going on in the company in order for them to be able to put in place a corrective measure or exercise their voting right. So we are proceeding. We still have important topics ahead of us. Ownership and control in non-corporate entities. The non-corporate entities are non-profit making organizations like the NGOs, the government, and the rest, that their own objective is to foster socioeconomic development, and the NGO maybe probably to assist the needy. The NGOs source their funds through private donors, corporate donors, and some other sources. So their own income or revenue they declare is as surplus. So the way we have ownership and control in corporate entity, it is quite different in that of the non-profit making organization. In that one, the owners might be the government or the public. In case of all these charity organizations and the rest, owners might be the government or the public. But in a corporate organization, the owners are the shareholders. Secondly, in a corporate entity, the power to control and govern, to lead a company, is given to the board of directors. But that is quite different in non-corporate entity, in that those in control, the power to govern a non-corporate body might be given to a management committee. So we also appoint a management committee. It is those management committee that will be vested with the responsibility, and they will be held accountable for the running of the company and whatever decisions that they take. So what is bad governance and what is good governance? Bad governance occurs when an entity is governed in a way that is inconsistent with certain concepts and practices. Yes, but we have some concepts and practices that happen to be the foundation on which corporate entities should be governed. All these concepts, we are going to look at it very soon as we proceed. And we have some practices like approaches to corporate governance. We have two approaches to corporate governance: the rule-based approach, and we have the principle-based approach. An effective and a good board of directors must ensure that they abide and apply these concepts and practices. If they do contrary, that will be referred to as bad governance. So overall, bad governance means that a company is governed in the interest of its director personally. That is what we mean as bad governance, rather than in the best interest of the owner. When a company board of directors evade tax, when they fail to comply with rules and regulations, when they indulge in any activities that drag the image of the company to disrepute, that is, damage the goodwill and reputation of the company, all these things are bad governance. Opposite of this is what we call good governance. Because in the good governance, there's going to be compliance to law. The company will be run with transparency, public disclosure as required by the law, because we have two types of disclosure. We have voluntary disclosure and we have mandatory disclosure. All those things are mandated by the law, will be disclosed. The company will act in line, will lay down regulations. All these things are what we call good governance. So the board of directors will be accountable, and they have to ensure that in all their decisions, the shareholders are carried along, including all investors. The company will be run to meet and satisfy the needs and expectations of the shareholders and all categories of stakeholders. That's a good example of what we call good governance. Under corporate governance, it is a very common thing that you are going to see Sarbanes-Oxley Act 2002. There's no way you will read that you not see this, even if it is online material. Sarbanes-Oxley Act 2002, Sarbanes-Oxley Act 2002, but of recent, ICAN did not set a question. It's a very common examination question that comes out very well. So, what is Sarbanes-Oxley Act 2002 all about? The Sarbanes-Oxley Act of 2002 was introduced in United States of America as a means to implement illegal measures and constraints due to the way and manner multinational companies that you don't expect can collapse in the next 200 years will collapse. The way and manner most of the financial institutions will just go on distress. So that's how the Austin Act
It's breaking.
now.
Hello,
Sir.
sir.
Hello, I'm
Your
with
voice
you.
is breaking. Your voice is breaking. Maybe you should check your network.
Okay, sir. Thank you.
It's clear here. It is.
Thanks for your.
It's clear. It's clear.
Okay.
It's clear
Okay.
here.
Okay, thank you. Let's proceed. So the Sarbanes-Oxley Act is now introduced to discover the factors that is causing the sudden collapse and liquidation of most of large and global corporations in the United States and some part of the globe. Because during that period in 2002, you can see example that I put here, we have the sudden collapse of Enron and WorldCom. These are world-leading companies in the stock exchange, financial institutions, and many more. So the Sarbanes-Oxley Act is now being introduced as a legal measure to improve the quality of corporate governance in the United States. And this act was embraced and is still adopted up to today by many companies across the globe. The same thing in the United Kingdom. United Kingdom too, they have their own code of corporate governance because they are really heated and affected too in 2002. And this one caused a global financial crisis. So United Kingdom, they use what we call the Code of Corporate Governance Principle and laws. So this one is a subtopic on its own that we are going to discuss today. But you must know that the Sarbanes-Oxley Act of 2002 was introduced as a legal measure to minimize the rate of collapse of multinational companies due to poor corporate governance and corruptions. At the same time, the Nigerian Code of Corporate Governance for private sectors in 2018 was prepared by Financial Reporting Council of Nigeria, FRCN. And that one required too that all the codes, rules, principles, and laws that the government stipulates in the Code of Corporate Governance must be abided by all companies. And by abiding by it, it has become a minimum standard for corporate governance behavior of organization. And the Nigerian Code of Corporate Governance, the code applies to all public companies, whether listed or not. Even those that are not listed, they embrace this code to better their business and ensure effective governance. So the course of corporate governance, we are going to look at it. So I'm just introducing the basic things that we needed to know. Next, the worker report and board behavior. Worker report and board behavior. What is the worker report all about? The worker report was brought into existence in United Kingdom between 2007 and 2009 when there's a global financial crisis. That global financial crisis began in 2007 and it was so ravaging that it cost across about 2 years or more than that, and now ended up to be a global thing. So Mr. David Walker carried out a report to know the reasons for this global financial crisis, and some of the findings of Walker's reports are the following. The Walker's report included the following comments about the contribution of poor corporate governance to the global financial crisis. One, the first thing that they discovered is that serious deficiency in prudential oversight and financial regulations. During that period that we are talking about, they said the reason for that global financial downturn and crisis was as a result of serious what? Deficiency in prudential oversight and financial regulations during the period. Secondly, is that they discovered that excessive risks are being taken both in the breadth and depth of the crisis. Majority of the company, last week we discussed about how we use our alarm, how we categorize our risks, and we made mention of risk appetite. So the report shows that majority of the company, they take high. They invest in a high risk business with high probability of occurrence. And majority of them, by the time the problem occurs, they are unable to cushion against these risks. And that's the more reason why companies must have a risk manager, you must have a risk committee, the internal and external auditors have a role to play, the board of directors too must contribute, external consultants must be involved before we take any decisions that has to do with our investments. So the workers' report shows that the chairman of the board, majority of them are weak and overstay in their tenure. And that's the more reason why retirement by rotation was introduced. I'm still going to tell you the meaning of the retirement by rotation, what it means, its advantages. Fourthly, in the workers' report, they said the composition and dynamics of the board is inadequate. And anytime you have that problem, there is tendency that the company can collapse truly. Because the board dynamism implies having ranges of board members with different knowledge, experience, ethnics, religion, background, qualification. I must have that balance. I must have that diversity in the tribal, in age, in everything, even in gender. So they discovered that most of the board, even they have problem of gender balance. So in one of the scholar, he now later come up with a report that require about 25% female gender inclusive in the board of directors. So what are the corporate governance issues? Corporate governance issues. The key issues in the corporate governance, which establish how well or badly a company is governed, are the following. Because in the corporate governance law, there are some areas that the corporate governance stipulates that emphasis should be placed on, and no board of directors should compromise. So the code of corporate governance covers the following issues. One, the role and responsibility of the board of directors. Under this, we are required that the board of directors should have a clear understanding of their responsibility. And this responsibility must be fulfilled with exemplary leadership style, and they must be accountable for this responsibility. That is number one. The second one, the composition and balance of the board of directors. I just explained this to you now. A board of directors collectively, an individual director should act with integrity. They should bring their independence of thought and judgment to their role. But what do we mean by composition and balance? The composition and balance means that this is the answer. The board should not be dominated by a powerful chief executive or chairman. It shouldn't be that one individual will be controlling the entire board. Maybe by a battle of he has been a director somewhere before, it has a political climate, or is a rich man or woman. No. We must have a balanced composition of the board in terms of age, gender, religion, experience, ethnicity, qualifications, and in terms of the number of executive director and net, ED, executive director and net, non-executive director, as stipulated by law. So the board must be balanced. Number three things that corporate governance discuss is financial reporting, narrative reporting, and auditing. This must not be compromised. And it should be done with transparency, without any hidden agenda. So the financial reporting should be transparent, it should be open, and whosoever that prepare the financial reporting as a committee or individual should be held accountable. Another one is directors' remuneration. All the directors must be well remunerated. It is advisable under corporate governance that we make comparison to what other companies are paying their directors, or what is obtainable in the industry. Because the only way you can retain a performing, experienced director is by ensuring that they are given a well remuneration and package. So apart from their salary, they should be entitled to incentives, rewards, share bonus. And anytime we give them shares, and I said at the time they want to start having access to this share, if the value of the share drop, we have to ensure that we upgrade the value of the share, or we ask some of our members to sell the share for them. That is what we call price water value. We are still coming to that. But we must know that all directors must be well remunerated, they must be given incentives, they must be well motivated. And we should give them a performance-related incentives. Risk management and internal control. The directors of a company should ensure that the companies operate within the acceptable level of risks.
Hello,
It is
sir.
not. Hello, I'm with you, sir.
Yes, the last immediate past point you just made about remuneration of the directors.
Yes, sir.
I know you were just explaining that this is what is required. But in practice, is these directors that usually fix their own remuneration, which makes it even more curious because sometimes they overdo it. Sometimes they do it to the detriment of the company itself.
Yes. You see, that's a vital point, and that's the more reason why there should not be a sort of a minimal or general collusion between the non-executive director and the executive director. Ideally, the directors should not have the opportunity to determine what their incentives or salary should be. But during appraisal, or when they are being newly recruited, they give them opportunity to know what was the salary you are earning before, what is your expectation now. We negotiate. This is what we are giving you. Going forward, we give you performance-related remuneration and incentives. But all these directors are not satisfied. Majority of them, they even want to be paying their incentives by themselves. In a way, as you rightly say, some of them, because of their own personal ambition, they ruin some companies, particularly upcoming emerging companies that have not fully stabilized. So in law, the power to determine the director's remuneration, their incentives and motivational package is given to NED, non-executive director. That is the ideal thing to do. And that's the more reason why the non-executive directors, they are not given any incentives. So there won't be any form of superiority complex. That's a vital point that you raised there. Okay, let's proceed. The risk management and internal control is part of the responsibility of the board of directors, and they have to ensure that this is done appropriately in order not to put the company into problem. Because anytime there is no effective risk management measure and internal control, then automatically the entire company will collapse. All their investment, their assets might be liquidated. In the corporate governance too, part of the things that the corporate governance law stated and the directors should know is shareholders' rights. Shareholders' rights vary between countries. But these rights that we are talking about, all shareholders must not be deprived of their rights because the shareholders are regarded as the owner of the company that fund, finance, and manage the company. They are the employers of the employees. They are the ones that put the directors in a position to manage and control the company on their behalf. So this power must be exercised with caution. We must ensure that all shareholders are treated with equity. When we are giving them dividends, must be with transparency. All their rewards, their voting right must not be deprived. And we must carry them along in every strategic decision made by the company. There should be disclosure and engagement. Corporate social responsibility. The corporate social responsibility is an ethical behavior by companies and are also issues related to corporate governance. And this one must be taken as a serious matter because we have some school of thought that is against this doctrine of corporate social responsibility. They are saying corporate social responsibility is a waste of resources. Corporate social responsibility companies are paying taxes to government and they expect the government to use this money to better the life of the citizen, create roads, rehabilitate roads, build schools, provide security. They have their points too. But we have another school of thought that are saying that the governments cannot do everything. And when the society is sick, automatically your business is sick. The school of thought says that companies draw energy from the society, including labor, and they must be able to compensate the society. So in a way, corporate social responsibility is a voluntary responsibility and obligation of the company that is embarked upon to better the life of the society and to be practically involved in solving the societal problem. As a result of that, the board of directors should encourage the company to be actively involved in CSR. But this one to have a significant positive direct effect on the performance of the company. Okay, so we proceed by looking at the code of corporate governance, community sector. Code of governance for voluntary and community sector. So what are the underlying principles? The principles are more or less the same. The first principle is board leadership. Board leadership means that whoever that is appointed as part of the board leader or committee, they have to ensure they exercise effective leadership and control. They must not betray the trust and confidence of those that appointed them into that position. And their leadership position must be used to set strategic direction and uphold the value of the business. The principle 2, the board in control. What do you mean by board in control? The board in control simply means the trustee as a board should collectively be responsible and accountable for ensuring and monitoring that organization perform well. They must be in control. They must have the capability to harness all the resources of the organization and achieve results. They must have a mutually benefiting relationship with the society, with the government, with the investors, with donors, and many more. The fourth principle that is necessary is that the board should be a high performance board. You must set goals, work towards achieving the goals, ensure what we call synergy. Because no individual can single-handedly work and achieve the aims and objectives of the company. No. We must ensure that we integrate, we work together. There is team unity, team direction, chain of command to achieve our results. Principle 4, the appointed committee or trustee must ensure board review and renewal. And these are periodic activities. And this one will help us to prevent what we call inertia, doing business in the same old and orthodox way. It will bring about restructuring, innovations. Principle 5, there should be delegation. Yes. A good manager is not the one that does everything by himself. You must delegate responsibility. You must formulate subcommittees. You can see that there. Some subcommittees have to be formed. Officers, CEO, and other staffs, let them have tasks and responsibility to perform. So with this, we are developing them. With this, we are working as a team. Because without delegation, it will be difficult for the managers alone to achieve all the strategic objectives of the company. All the routine functions can be delegated and supervised, while the managers will focus on the strategic issues. The sixth principle boils on integrity. That is probity. In everything we do, integrity must be the first thing that we consider. We must act with integrity and act within the law. And we must embrace ethical standards and avoid insubordination of interest. Our own interests as director, CEO, managers must not be greater than that of the company. The seventh principle, which is the last principle, discusses about openness. So openness, that means transparency. We have to be open. So without openness and transparency, it will give us opportunity to be able to achieve going concern sustainable growth for the company without creating any unnecessary problems. So what are the concepts and features of good governance? Please, these concepts and features are advised at least you should know about minimum of 5. That's something that is simple. In fact, we can write it on our own because it comes out in exam very well. The concept, what are the concepts or characteristics of a good governance? If they don't ask that one, they can ask you, what are the 7 lunar principle of public life? All those principles of lunar too, they are part of this one too. Please, no question is too simple or small to ask in exam. The examiner can ask this. So that what are the characteristics or the concepts or features of good governance? The characteristics of good governance, I'll just list them while we proceed because we still have some things to cover, is 1, there should be fairness. Fairness in principle, in policy, in sharing of dividends, in appraisal, giving of incentives, dealing with shareholder stakeholders, the government and the community. There should be fairness. 2, there should be openness and transparency. That is key. Number 3, there should be independence. The reason for this independence is that the board of directors, individual managers, and directors should take some independent decision. They must not allow at all time external influences, even internal influences, should not override their own judgment in ensuring accountability and efficient achievement of their tasks. So we have to make independent judgment, unbiased judgment on behalf of the company. Another one is honesty and integrity, which we call probity. In all our dealings, we have to act with integrity. We have to uphold ethical standards. We must not compromise it, because it will rub on your integrity and it will rub on the integrity of the company too. And this one will cause reputational damage and increase the risk of doing business by the company. So responsibility and accountability is there, and reputation. Reputation is key, because a large company is known widely by its reputation or character. And it takes years for a company to build this reputation. And this reputation must not be soiled by a singular act. And that's the more reason why we have to ensure in everything that we do, we don't compromise the reputation of the company. So those are the concepts or principles of corporate governance: transparency, judgment, reputation, honesty, responsibility, independence, fairness, openness, accountability. So related to that is the Nolan 7 principle of public life. Nolan 7 principle of public life. The Nolan concept described above apply to public entities, and that's the reason why you see it as Nolan 7 principle of public life. Those people that work in the public corporation, like government agency and the rest. This principle, Nolan said, they are the principle that we use to operate, achieve your daily operational activities, and achieve results. So the concept of Nolan principle described above apply to public sector entity and not-for-profit organizations. So the Nolan 7 principles comprises of the following. 1, selflessness. Nolan said that all individuals that is working with corporate organization, public sector, you must render selfless service. Holders of public office should not make decisions that are in their personal self-interest. Their decision should be what? Based entirely on concern for the public interest. 2, integrity. You must act with integrity. Number 3, Nolan said objectivity is another principle, guiding principle for public office holder. Holder of public office in awarding contracts, that is the area of competitive bidding, just cite as example, or making recommendation, should base their decision on merit. Accountability, you should submit yourself for accountable, and you should know that whatever decision you take, whatever responsibility you carry out, you'll be held accountable for it, good or bad. 5th, openness. Holders of public office should be as open as possible about their decisions that they take, and that decision must be for public interest. Because like I say, for instance, now, if you carry out a project and you say that project is 200 million naira, we have to evaluate it. Maybe that contract is not, there should be judicious spending of the taxpayers' money. There should be openness. The next one is honesty, while the last principle of NOLAD is leadership. So quickly, what is our agency theory? Agency theory. Agency theory. In this agency theory, please, you are not expected to go beyond what the syllabus required. Particularly some of us that are maybe probably in undergraduate, we have interest in business law, we have done principle of law, commercial law, or some that our background has to do with law. So what the agency theory does talk about is what are the fiduciary duties of directors? What are the things that is causing agency crisis between the shareholders and the directors? What are the things that we can do to reduce or minimize this agency crisis conflict? But the agency law here is not talking about the normal definition of agency, formation of agency relationship, termination of agency relationship, types of an agent, all these the credit agent, factor agent, agency of ratification, agency of estoppel. No. It's not talking about that, please. So the law of agency, who is an agent? An agent is a person who acts on behalf of another person, the principal, in dealing with other people. To save time, an agent are the directors, the employees, our support staff, who are employed by the principal. The principal is the shareholder. So the agency relationship under corporate governance is the relationship that occurs between the shareholders, which is the owner of the company, and the appointed directors and employees. That is simple definition that we must know here, and not that of the business law. Because if I want to take you into that, I can take you into that, but we are derailing from the syllabus. So in company law, the directors act as agents of the company. They act as agents of the company, while the shareholders, we refer to them as the principal. So what is the meaning of fiduciary duty of director? Fiduciary duty of director. As agents of the company, directors have a fiduciary duty to the company. And what is that fiduciary duty? A fiduciary duty is a duty of trust. It's a duty of trust. And that is what we call acting with utmost good faith. UTMOST FAITH. Your fiduciary duty is to act with utmost good faith. Duty of trust. In all dealings, you must put the interest of the principal, the shareholders first. Because if you go contrary, this your action is punishable under law. Okay. Agency conflicts. Agency conflicts. What do you mean by agency conflict in corporate governance? Agency conflicts are differences in the interests of the company's owners and managers. And these conflicts can arise in several ways. What are the ways or things that is causing agency conflict between the shareholders and the appointed directors? Number one is moral hazard. Moral hazard. A manager has an interest in receiving benefits for his or her position as a manager. This includes all the benefits that come from status, such as company cars, private shares, and what have you. So how does these incentives curiosity for all these incentives, private car, access to the private jet of the company cause moral hazard or agency conflicts. Let's see how it causes. McLean suggested that a manager incentives curiosity to obtain these benefits is higher when he has no share. He said, in a company whereby the manager does not have a share option or is not a member of the shareholders, he only entitled to his remuneration and some fringe benefit is deriving, that some of these managers might be curious for them to look at other areas of earning returns, other areas of making additional money. And in so doing, some of these managers who can even invest in some high risks that go against the level of risk appetite of the company. And this one will cause a lot of problem. So in a way to increase their incentives, in a way to pay their own benefits themselves, they perpetrate or make some decision that is not in the best interest of the company. And that's what we call moral hazard. 2, effort level. Effort level. Managers or directors may work less hard than they would if they are the owners of the company. So, meaning that the senior managers, because of their curiosity for higher returns, and also, we made mention of it in the course of our lecture, that most of these directors, they are paid performance-related benefits. So for them to earn high performance-related benefits, they take some decisions, invest in some high-risk business that create a lot of internal disequilibrium and tension. Because if the business should collapse, then automatically it will ruin the company. So because of their anxiety, desire to gain high interest and high level of incentives or share options, they take high level of risks, and this one causes a lot of crisis for the company. The same thing with any retention and risk aversion. Let's look at risk aversion. We have mentioned this about 2 or 3 times. Risk aversion. Please, let's follow. Executive directors and senior managers usually earn most of their income from the company they work for. Yes, correct? They are therefore interested in stability of the company because this will protect their job and future income. Yes, they don't have other means of livelihood than the salary, the income, incentives they gain from the company. And how can this risk aversion cause crisis? It will cause crisis because the shareholders might be having certain level of risk percentage. The directors might be saying that no, this level of risk is low. Let's invest in this high one. At times, the director might want to play safe, to invest in a low risk averse, shy away from high investment. The shareholder might say, no. So far it is profitable. We don't mind. Invest in the high risk investment. So let's proceed. This means that management might be risk averse. The directors want to minimize the level of risk they take in whatever investment decision they take. That's what we call risk averse. Management might be risk averse and reluctant to invest in high risk projects. But contrarily, shareholders might want a company to take a bigger risk. Then there will be conflict between them. That is exactly what the subtopic is talking about. Agency conflicts. Also, time horizon. Shareholders are concerned about the long-term financial prospect of their company, whereas the directors, they might be concerned about what? Short-term interest and benefits. This one will cause crisis between them too. It's an interesting topic. Then we look at agency cost. Please note, agency cost. Agency, be it agency conflict, agency cause, there are things that we can write in our own. You can see all the solutions that we are providing for them. There are things that we can write. Like this agency cause, let me just tell you so that you know that in your own simple English, your experience, you can just put it down on your own without even look at any textbook. Agency cost simply means the total amount of money that the shareholders spend in managing agency conflict and ensuring effective governance of their business. That is what we call agency cost. So all those money that we spend, be it as incentives to ensure that we satisfy our directors, for them not to create a problem for us and liquidate the company, is agency cost. All the money we give to whistleblower to give us information about activities, hidden activities in the company, is agency cost. All the cost of what's it called? All the cost of a constant meeting, external auditors, they are agency costs. Okay. So agency costs, the agency costs cover the following costs. Cost of monitoring. So the owner of a company, that is the shareholder, can establish a system for monitoring the action and performance of the management. So to try to ensure that management are acting in their best interest. So all the additional money that the company is spending as a cost of monitoring the activities of the director, that is one of the agency costs. Another agency cost is residual loss or losses. Residual loss or losses. Agency costs also include the cost to the shareholders that arise when the manager takes decisions that are not in the best interest of their shareholders. Maybe bad debts is a good example of residual loss. Or some business that we did at the end of the day, the profit we realize from it is not viable, or we struggle to break even. All those losses are residual losses. Another example of agency cost is bonding cost. What do we call bonding cost? Bonding cost, it is the cost that might be incurred to provide incentives, rewards, motivational package to the managers for them to act in the best interest of the shareholders. We are giving them all these things to minimize agency problem, believing that by the time we satisfy them, we give them what other companies are giving their directors. So this one will make them to be more contented and put the interest of the company first in everything they do. And you can see part of the bonding cost. Let's proceed further here. Directors and other senior managers might be given incentive in form of free shares in company or share options. All these things are bonding costs, and they are part of the retention strategy that a company put in place to retain a performing directors. So at times we give them cash bonus when they meet certain financial targets. So what are the strategies that you can use to reduce agency problem or conflicts? Strategy to reduce agency problem. 1, devise a remuneration package for executive directors and senior managers. And this package and incentives must conform with the industry standard, with what other companies are giving their directors. Another thing that we can do to reduce agency problem is use of whistleblowers. And when these whistleblowers discover a red flag, they inform us, we must act on it. And we must ensure that the whistleblower are not giving forceful information, or they are not giving information to victimize any director. Because failure to reckon with the whistleblower information, it can cause havoc. Another thing that we can do to minimize the agency problem is the use of retirement by rotation policy. I think I mentioned that before. What we call retirement by rotation. Retirement by rotation is a corporate governance strategy that is put in place by the owners of the company, that is the shareholders, to checkmate the excesses and abuse of power and underperforming of appointed directors. We call it a retirement by rotation because it spells out the duration or tenure that the directors is going to use in office, and preferably 3 years. Normally, in some companies, the directorship tenure, let's say for instance, is a single tenure of 5 years. Anytime we are using retirement by rotation, it will not be stated in the letter of appointment of the director that the director will use a 5 years at a stretch. No. By retirement by rotation policy, the director will be informed. We congratulate the directors and inform the director that you have been appointed as the director of this company, and you are expected to use 3 years. After which you step aside and allow the board of directors and the shareholders to review your performance. If the director performs up to expectations or supersede the expectation, the directors can be given additional 2 years or reappointed. But if the director performs below expectation, then his tenure will not be renewed. It's a very good way of removing directors that did not put the interest of the company first, directors that run institutions and fail to build a succession plan for the company. So this one will not bring about litigation problem going to court because it has been boldly stated in the letter of appointment. So we quickly look at the theories of corporate governance. Theories of corporate governance. Theories of corporate governance. The first theory of corporate governance that we are looking at is transaction cost theory. The transaction cost theory attempts to explain that companies should not just act as an economic unit, that we are just after profitability, high return on investment and the rest. So it's fine. Because even Porter said that our objective should be to set a long-term goals, an objective that bring about high return on investment. And we must not place priority on increase in sales volume and market share. Fine. But the transactional theory is now explaining further that companies should not just act as economic units, but as organizations consisting of people with different views and objectives. So this means that we must ensure that all the staff of the companies are recognized. They make valuable contributions. We use open policy system to ensure that at all levels, our staff has contribution to make, because the managers, the directors alone cannot do everything. That is where the transaction cost theory is saying. He said the managers cannot do everything. Even as human being, there is limit of talent, gift, capacity that God give individual. As a result of that, The transactional theory goes further to say that transactional cost economics changes this assumption by trying to allow for human behavior. Just follow. And the fact that individuals do not always act rationally. Therefore, transaction cost theory is based on two assumptions. What are the assumptions about the behavior of director? The first one is bounded rationality. That bounded rationality is what I told you, that human act rationally, but only within certain limits of their understanding. So any areas where they have deficiency, weakness, we should be able to support them. And that's one reason why a company must act as a whole, as one, and not just so isolated. That it is director, now he's taking the larger this thing, they eat fast. Let them go and face the crisis. We must support them. Two, opportunism. That's another behavior. He said individual act in a self-interest way. And if you just leave them without checkmating them, monitoring them, they will act in their own best interest, for their own personal gain, and perpetrate fraud without any honesty or integrity. That's the first theory that we call transaction cost theory. The second theory of corporate governance is stewardship theory. Stewardship theory. The stewardship theory says that all appointed directors, managers of a company have a stewardship role to play. That all directors, managers, they are stewards to the owners of the company. As a result of that, we should be able to manage their investment very well. All their assets, material resources, human resources, portfolio of investment should be effectively managed. Because that's the contract we sign. That's the oath that we sign. Number three theory, resource dependence theory. The resource dependence theory, in summary, is saying that organization should ensure that there is effective use of their limited organizational resources, because the only way a company can achieve going concern, the only way the company can gain competitive advantage and high return on all their investment is by ensuring that their manpower, machine, methodology, money, equipment, time, facilities, information, everything is used effectively. The company should be able to leverage on their resources at their disposal to achieve whatever objective or goal they have set to achieve, maybe in the short, medium, or long term. And the resource dependence theory is saying that in leveraging our resources, we must not set a goal that we don't have the resources to achieve. So the resource dependence theory is saying that the resources of the organization are a basis of power for achieving whatever objective we intend to achieve. Number four theory of corporate governance is what we call managerial ergonomy theory and class economy theory. Very simple. Both managerial economy and class economy theory have the same meaning as far as I'm concerned. The first one, the class economy theory, is a masses-based theory that considers the business elite, upper class. When we are talking of upper class, we are talking of the senior managers, the board of directors, executive directors, CEOs. He said the upper class, he considers them as a group of individuals who control the governance of the company to perpetuate their power base. He said at times some of them, they are even power intoxicated. They are the decision maker because they have been vested with their judiciary duty, legal duty, and authority to govern the company. So at times they abuse this power, and most times they use the power effectively. So because they have that power, they have that economy, at times they become an arrogant species And this should not be. Managerial economy theory, the managerial economy theory is saying the same thing, that corporate governance, the control and everything lies in the hands of the managers, the directors, and the board of directors. And this one, when abused, might give them opportunity to perpetrate fraud and self-interest. As a result of that, shareholders must ensure they spend certain amount of money as part of agency fee to monitor the activities of the directors. And in a way to reduce class hegemony and managerial economic crisis, we need to use non-executive director and whistleblower. That's the secret. Stakeholders theory. What does the stakeholders theory says? The stakeholders theory of corporate governance is that governance depends on interrelationship and relative strengths of the different stakeholders of a company. I think I will have expatiated more on this in the notes. So what the stakeholder theory is saying is that the directors of the company should ensure that while they are striving to manage the investments of the company, generating substantial returns, paying dividends, and seeing to satisfaction of the expectation of the shareholders, they must ensure that the welfare of the stakeholders too is considered. Because the stakeholders, they are the lubricants that is willing the organization. They are the assets, the people that is allowing the company to achieve its set goals. So all their contributions must be duly compensated for. So companies must not just embrace shareholders theory that says everything that comes in from the company should be for the shareholders. No, the stakeholders too should be considered. Their welfare is equally important. And we now have system theory. The system theory approach to corporate governance consider a company and as what? Overall system. A system theory approach to corporate governance consider a company as what? As an overall system. Meaning that a company consists of interlinked subsystems. That the company does not just stand on its own. It has lower level, middle level, and frontline level. We have top management too. All these levels must interact as a system. And even this area, when you look at Henry Misbach, 5 building organization structure, Henry Misbach says that in an organization is a system that comprises of subsystems. And these subsystems are of 5 that make up the entire system. He said in a company, we have strategic apex. Those are the top management, CEO, board of directors, manager, strategic apex. He said we have technostructure. Those people that provide technical assistance, support, accountants, engineers, IT staff. We have support staff, vendors are there, security, cleaners, they are there. We have middle line, all these functional manager, strategic business unit manager. You can see that a company is a system, and you must work collectively as a system to achieve the goal of the company. So having looked at that, so we look at the role of information technology in governance. Role of information technology in governance. So governance and information technology. So what are the functional scope of governance? Functional scope. The functional scope of governance includes finance and operations, marketing and sales, administration, human resource management, information technology, risk management and internal control, strategy, compliance. These are some of the operational scope of management are the functions that the board of directors are performing, including financial reporting. So what are the roles of information technology in governance? Some of the roles of IT in governance are the following. One, ensuring adequate information technology and information system. Apart from being a digital era, no company can survive and achieve their pre-stated goals without automation of their business. Another role of information technology is ensuring adequate funding is available to support the IT capability of the firm. Because the IT system, we need renewal, restructuring, realignment, updating. So there should be a budget for this. Another role of information technology is that the information technology or information system strategy should be in place and must align with the organization overall goals, vision, and objective. Also, information technology is a robust system for internal control. Another contribution of information technology is that information technology assets and data are safeguarded. And these are areas where companies are spending millions of naira to avoid cybercrime because of all these fraudsters that operate in the dark web. So information technology also help in personal data protection, cyber risks, and many other benefits. So the more we have looked at that, next we have to look at different approaches to corporate governance. Different approaches to corporate governance. There are basically two major approaches to corporate governance. We have one, the rule-based approach, and two, the principle-based approach. I'll repeat that. Approaches to corporate governance. There are two main approaches to corporate governance. We have one, rule-based approach, and we have two, principle-based approach. The rule-based approach. You don't need any cramming or whatever here. As the name implies, rule. That means that the rule-based approach comprises of some basic fundamental rules, or you use the word laws or regulations. You have answered it. So the rule-based approach to corporate governance, what does it mean? A rule-based approach to corporate governance is based on the view that companies must be required by law to comply with established principle of good corporate governance. I will simplify it. The rule might apply not only to some type of company, such as major stock market companies. However, for the company to which they apply, the rule must be what? Obey. The rule must be obeyed. So what we are saying is that in the rule-based approach to corporate governance, the rule-based approach to corporate governance comprises of some rules, laws, and regulations by the government, both in Nigeria, in UK, in America, and all parts of the globe. There are rules that guide corporate governance, particularly for companies that their shares are traded in the stock exchange. They must abide with all these rules rigidly without any form of violation. Because any attempt to violate any of these rules is punishable under law. Litigation will be served, and that case will be decided in a court, recognized court in the country. And that's the more reason the rule-based approach have zero tolerance for violation. So the essence of this rule-based approach is for us to have a uniform law that will govern corporate governance in the country. And this one will help us to minimize fraudulent practices, deficiency in corporate oversight, and sudden collapse or liquidation of companies. So what are the advantages of the rule-based approach? One, companies do not have the choice of ignoring the rules. It is binding. That is what I'm trying to say there. It is binding on all companies. Two, all companies are required to meet the same minimum standard of corporate governance. The rule is uniform and is binding on all companies. Number three, another advantage of the rule-based approach is that it boosts the confidence of the investors, because these rules improve and encourage total compliance, and this one brings about effective governance. What are the disadvantages of the rule-based approach? Disadvantages. One, the same rule might not be suitable for every complaint because the circumstances of each complaint are different. That means the rule is not flexible. That is the meaning. Two, a system of corporate governance is too rigid if the same rule are applied to all complaints. In line with that rule-based approach, in the United Kingdom too, we have some rules guiding corporate governance in UK. And mostly in the United Kingdom, they use more of the principle-based approach than the rule-based approach. And some of the information contained in the rule and principle-based approach in the United Kingdom are the following. One, it said the financial statement should be audited. Two, quoted companies must prepare a director's remuneration report each year. Director remuneration report must be prepared and it has to be presented to the shareholders. Three, the UK Company Act specified duties that the directors owe to their company. So all these ones we have is in the rule-based approach. And you must know that the rule-based approach came in after the sudden collapse of global multinational stock exchange companies in America. That is Enron and WorldCom. And that's the time that Sarbanes-Oxley laws and research was carried out. And the essence of this rule-based approach is to address these ugly incidents so that going forward, we'll not be able to have this kind of problem again. No, like I told you, in the Sarbanes-Oxley, they told us some of the reasons why the companies collapsed. And that's the reason why every country, they are now having a rule-based approach to corporate governance. They are now having a principle-based approach to corporate governance. Because they are trying to avoid a situation whereby some of these directors will dominate the company and ruin the company. Some of them, they might have doctored their financial reporting and mislead the shareholders and the public. So that's the reason why we have the Sarbanes-Oxley Act and the rule-based approach. So let's go to the principle-based approach quickly, because our class ends 5:30. I doubt we are going to finish this slide. The principle-based approach to corporate governance. A principle-based approach to corporate governance is an alternative to a rule-based approach. That means this principle-based approach is not eliminating or trying to eliminate the rule-based approach. It's just trying to give a sort of flexibility and not replacing the rule-based approach. So that's the reason why I put it as alternative to a rule-based approach. And this is what is being used in some parts of the globe including your United Kingdom. We proceed further. The rule-based approach, our principle-based approach, it is based on the view that a single set of rules is inappropriate for every complaint. That is one of the disadvantages of the rule-based approach, that how can one binding rule will be binding on all complaints, irrespective of size, age, their nature of operation. So this principle-based approach now bring about some flexible principles that the directors of a company must abide with. And these principles that we have, the principles are compulsory. You must comply with it without any form of violation. But this principle-based approach, the reason why it is different from the rule-based approach is that anytime, any day, any director of a company violates any of these principles, the matter will not be taken to court. It will be decided by the shareholders of the company. The shareholders of the company will set up a committee, and the director in question will come before them to defend himself, the reason why he violated the principles that's supposed to be a guiding principle for conducting business and seeing to transparency in corporate governance. So the principle-based approach is binding too, and all the provisions there have to be abided with all directors. We must know that the principle-based approach gives opportunity for what we call comply or explain. And that's one of the reasons why me too I love the principle-based approach, because it is flexible. What do we call comply or explain under the principle-based approach? The comply or explain simply means that in case the director violates or violated any part of these principles, you have the option to defend yourself before the shareholders by explaining the reason why you fail to comply with the principles. Let's see, comply or explain. This approach is sometimes called comply or explain. It applies in the UK, for example, and same in Nigeria. We have some companies that use it. With a comply or explain approach, stock market companies are required to present a corporate governance statement to their shareholders in which they state that comply with all provisions or guidelines in the code for applying the principle in practice. 2, explain their non-compliance with any specific provision or guidance. So in case you violate any part, any section or subsection or page of the principle base, you have to justify the reason why you fail to comply with that provision. Maybe by virtue of oversight, omissions, intentionally or unintentionally. You have to justify this. And it is now the duty of the shareholders to look into the excuses that you give, whether it is genuine or not. If those excuses are not genuine and they violate the principle, the directors can be removed. The directors can be suspended. Other capital punishments can be leveled against the directors for failure to comply with the principles guiding corporate governance in the organization. So if in case we are being asked which one is more effective, a rule-based approach or principle-based approach, both of them are effective. It depends on the circumstance. It depends on the one that you want to use. And some companies are using the two. So I can't say precisely that rule-based approach is the best, principle-based approach is the best. But both of them bring what we call sanitary into effective governance, and they reduce fraudulent subordination of interest and poor running of the company without any succession plan. Okay, I think lastly for today, we have to stop by looking at the reasons for the development of corporate governance code. What are the reasons for developing the corporate governance code? That is the rule-based approach and the principle-based approach. So the reason why we develop them, they are not far-fetched and it is all known to us. One is for us to ensure transparency in corporate financial reporting. That is one of the key reasons for development of corporate governance code, to ensure transparency in the corporate governance code. Two, another reason is to prevent premature death or collapse of companies. We don't want any sudden deaths of companies that serve as pillar of support to the community and the government. Because these companies are generating revenue to the government, creating job opportunity, contributing to socioeconomic viability. Another reason for the development of the corporate governance is to uphold probity, integrity, ensure accountability and transparency, and public disclosure. So we have so many reasons why the development of Code of Corporate Governance as a rule and principles are established. Another reason that we can say as part of the reason for development of corporate governance is to boost the confidence of investors. Because a lot of investors are now panicking due to the way and manner corporate entities are being governed. Majority of the shareholders are dissatisfied. But with these rules and principles, the investors' confidence are boosted because they now have the reassurance that we have the uniform laws or rules that guide the code of conduct of all directors. So by this, we are going to come to the end of the lecture for today. Hopefully by our next class, we have to start with an international code and principle of corporate governance. I will separate the slide from that place down to other topics that we have. I think it's a thing that we can finish today, but we can't finish, and I can't rush all this topic. It's beyond the exam. We have to ensure that we gain and have the knowledge on this. So we still have so many things to look at. I can see board diversity and many topics that are here. So this one, they are the topics that we are going to proceed with next week. So I appreciate your time, effort. Is there any question before we call it a day, sir? Ama? Okay, in view of no question, we meet in peace next week.
Okay, sir. Thank you, sir. Sir, please, we will need the material because we don't
I will
have
do
the
that. I will do
material.
that, sir. I will do that. Proud of you all. Bye.